Welcome to this explainer. Today we're looking at something that is absolutely fundamentally shifting how we think about income and taxation. Based on some fascinating recent expert reports, there's this new legislation that grants highly targeted tax deductions on tips and overtime pay. And let me tell you, it is already creating some serious ripples in the labor market. Now, our goal today isn't just to boringly read off a list of new rules. Instead, we're going to act like an analytical engine here. We want to really explore the underlying rationale, uncover all those implicit assumptions, and most importantly, ask the hard questions about systemic equity. So to set the stage, I want you to consider this structural question. Traditionally, tax systems really only care about your total gross income, right? A dollar earned is a dollar taxed. It doesn't matter if you made that dollar at 9 a.m. on a Tuesday or 9 p.m. on a Saturday night. But what happens when tax legislation actually starts targeting specific wage types? Like, what systemic market distortions pop up when you suddenly shield a tip from taxes, but still fully tax a standard hourly wage? When we start incentivizing how a dollar is classified rather than how it's actually generated, we inevitably create ripples, maybe even waves in the labor market. So, based on expert analysis, we're going to look at exactly how this new system tries to control those ripples. Okay, let's dive into this, starting with the hard numbers. The absolute core mechanism of this legislation provides a maximum annual deduction limit of exactly $25,000 for qualified tips. And this is what we call an above-the-line deduction. That means it reduces your taxable income right off the top, before other calculations even happen. Now, here's a really crucial, non-obvious detail. That $25,000 limit, it applies per tax return. It completely ignores whether your filing status is single or married filing jointly. It's a flat cap. And honestly, this represents a massive, massive carve-out for a very specific segment of the workforce. Now, right alongside tips, this legislation also targets overtime pay. But the math is a bit different here. For a single filer, the maximum annual deduction for qualified overtime pay is capped at $12,500. But, and this is a key data point to remember, unlike the tip deduction we just talked about, this overtime cap actually doubles. It goes up to $25,000 for joint filers. This immediately reveals a glaring structural difference in how the legislation treats these two very distinct wage types. It's essentially setting up strict mechanical boundaries to try and contain the overall fiscal impact. Of course, they had to build in some guardrails, right, to prevent high-income earners from swooping in and exploiting these targeted deductions. The system utilizes a really strict phase-out threshold, and that threshold is exactly $150,000. If a single filer's modified adjusted gross income creeps over that amount, or over $300,000 for joint return, that deduction begins to rapidly phase out. So this explicitly frames the whole legislation as targeted economic relief meant for the working and middle classes. It is definitely not designed to be some broad tax shelter for the ultra-wealthy. Now, what's really interesting here is just how ruthlessly strict the legislation is when defining what actually constitutes a quote-unquote tip. According to the expert analysis, a tip absolutely must be a voluntary, non-negotiated payment coming directly from the customer. On the flip side, mandatory automatic service charges, like that automatic 18% they add to a large party's restaurant bill, those are completely excluded from the deduction, zero tax benefit. And the implicit rationale here is pretty clever. Think about it. If the law allowed mandatory charges to be deducted, businesses would literally just relabel their standard base prices as service charges. They use it to artificially manufacture tax-free income for their employees. We actually see a very similar level of surgical precision applied to the overtime deduction, too. It's not just a free-for-all on your whole overtime paycheck. As defined, this deduction applies exclusively to the overtime premium. So what does it actually mean for the worker? Well, if you earn time and a half under fair labor standards, this deduction isolates and applies only to that extra half portion. It completely excludes your normal base hourly rate for those same hours. By isolating this very specific variable, as the expert reports note, The legislation prevents workers from artificially inflating their base pay through, let's call it, creative scheduling. It ensures that only the true premium penalty, the extra bit paid by the employer, is what actually becomes tax advantaged for the worker. Section 1, Occupational Distinctions and Anti-Abuse Guardrails. Analysts know that human nature is, well, human nature. People are always going to try to exploit tax loopholes if you give them half a chance. So, to prevent this kind of widespread exploitation, the legislation doesn't just look at how you are paid, it actually looks at what you do for a living. The benefits are implicitly restricted to a very rigid list of approximately 68 recognized occupations. Basically, you absolutely must work in a field that customarily and regularly receives tips. And the underlying assumption here is really profound when you think about it. The idea is that without ring-fencing this deduction to specific, historically tipped jobs, literally the entire labor market would start attempting to reclassify their standard bonuses and commissions as tax-free tips. It would be chaos. And this brilliantly illustrates exactly where they've drawn that line in the sand. On one side, look at the historically accepted tipped roles. We're talking food and beverage servers, casino dealers, salon professionals. Now compare that to the other side, consultants, legal professionals, high-income freelancers. These folks are categorized as specified service trades, and they are categorically excluded from this whole thing. Let's be real, you cannot be a financial advisor, receive some massive end-of-year cash bonus from a wealthy client, and then try to creatively claim it as a $25,000 tax-free tip. The system just won't allow it. The system actually actively excludes businesses where the primary value is driven by the skill or reputation of the owner or employees. Now, this is a really critical, non-obvious detail that's easy to miss. The implicit assumption here is that highly skilled professionals already have the leverage to negotiate their compensation structures, right? If they were given access to this deduction, they would absolutely systemically re-engineer their contracts. They'd swap out taxable salaries for these so-called tax-free tips in a heartbeat. So these rigid guardrails exist for one very specific reason: to stop high-level tax engineering right in its tracks. Section 2, Strict Compliance and the Mechanical Parameters. As we all know, whenever legislation offers a substantial carrot, it almost always comes with a heavy stick. And the mechanical parameters required to legally execute these particular deductions leave absolutely zero room for error. First off, you must have a social security number that is valid for employment. Also, if you happen to be self-employed, your tip deduction cannot just magically exceed your actual net profit. Basically, you can't use this as a clever trick to generate a paper loss. But honestly, the most striking requirement to me is that second point right there. If you are married, you are strictly mandated to file jointly if you want to claim these deductions. Seriously. If a married couple chooses to file separately for literally any reason, they are instantly entirely disqualified from receiving a single dollar of this tax relief. It is an incredibly harsh binary compliance mechanism. Section 3, Systemic Equity and Labor Market Distortions. Let's move on and see how all of this builds into a real-world scenario of what analysts call horizontal inequity. Let's paint a picture here. Consider two workers, right? Both are making exactly $80,000 a year, and both of them work exactly 50 hours a week. Now, the first worker is an hourly employee, and because they're hourly, those extra 10 hours a week officially classifies overtime under federal labor standards. This allows them to deduct that premium portion we talked about and significantly lower their overall tax bill. But then look at the second worker. They are a salaried exempt employee. They are working the exact same number of hours, they're taking home the exact same total compensation, but under the system, they receive absolutely zero tax relief. Which really leaves us with this somewhat cold, highly objective question to wrap up our explainer today. Does a system that heavily taxes a salaried worker while giving a break to an hourly worker, despite them having identical gross income and putting in the exact same hours, truly represent a structurally fair tax advantage? I mean, we've explored the rationale behind it, we've looked at those incredibly strict anti-abuse guardrails, and we've broken down the mechanical execution. But the big question of whether this targeted relief actually creates a truly equitable labor market, well, that is a wildly complex puzzle. I really hope this deep dive into the expert analysis has given you a fresh behind-the-scenes perspective on how these targeted wage deductions actually function beneath the surface. Thanks so much for joining me for this explainer. Keep asking those hard questions, and I can't wait to explore more fascinating topics with you next time.